Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial mysteries that shape our world. And in today's filing, we're going to uncover if Graphjet Technology's ambitious plans for a bio-based graphene and graphite business are stacking up, or if they're just blowing smoke. Let's dive into their latest annual report and see what is really going on behind the scenes with this innovative materials company. So before we get into the nitty-gritty financials, let's set the stage. Graphjet Technology, formerly Energem Corp, went through a big change. They were essentially a blank check company, meaning they were formed just to buy another company. And on the 14th of March 2024, they officially acquired Graphjet Technology SDN BHD, a Malaysian company with a cool idea turning waste, specifically palm kernel shells, into artificial graphene and graphite. The goal is to produce these critical materials cheaper and more sustainably than the old ways. Sounds promising, right? But as always, the devil is in the details, and the financials tell a bigger story. Okay, let's hit the balance sheet, the snapshot of what the company owns and owes. As of the 30th of September 2025, Graphjet Technology had total assets of about $4.4 million. That might sound small, but it is actually more than double what they had the previous year, which was around $2.2 million. This growth in assets is partly because they've been investing in property and equipment, which went from about $1.6 million to over $1.8 million. They also have this big chunk of over $2.3 million in prepaid deposits, likely for that factory building they're planning to buy. Now, on the other side of the coin, the liabilities, which is what they owe, are pretty high. They owe over $15 million in total, with a significant portion being current liabilities, meaning they owe it soon. This has resulted in a shareholders' deficit of over $10 million. That means if you were to sell everything they own today and pay off all their debts, there would be nothing left for the shareholders. This is a big red flag and something we need to keep an eye on. Now, let's look at how they're doing in terms of making money and spending at the income statement. For the year ended the 30th of September 2025, they reported revenues of just over $92,000. Now, that sounds incredibly low, but remember, they're still in the early stages and just starting to sell some side products. The cost of generating this revenue was actually higher, around $192,000, leading to a gross loss of about $100,000. This isn't ideal, but it is not uncommon for companies in this phase. The real story here is the operating expenses. General and administrative expenses, which include things like salaries, marketing, and legal fees, dropped significantly from about $17.4 million in 2024 to just over $3.2 million in 2025. This huge drop is mainly because they had a big bonus provision last year for senior management that got reversed this year due to some resignations. On the flip side, share compensation expense jumped up by $19.2 million. This often happens when companies issue a lot of stock options or warrants, which is a way to pay employees or partners. Overall, their net loss for the year was around $16.4 million. While this is a smaller loss than the almost $17.8 million loss in 2024, it is still a substantial amount of money they're losing. Moving on to cash flow, this tells us where the cash is actually coming from and going. In the year ended the 30th of September 2025, they used about $2.1 million in operating activities. This means their day-to-day business operations are draining cash. They also used about $433,000 in investing activities, likely for buying equipment. On the financing side, they brought in about $2.3 million. This cash came from things like new loans and issuing more shares. However, their cash balance at the end of the year was just over $7,000, down from about $348,000 at the start of the year. This tight cash situation is a major concern and highlights their reliance on external funding. Now, let's talk about the risks. Companies have to tell you what could go wrong, and Graphjet Technology has a whole list. A big one is their limited operating history, making it tough to predict their future success. They also have a serious going concern warning from their auditors, meaning there is doubt about whether they can stay in business for the next year. This is a serious red flag. They face risks in their graphene and graphite business, from competition to the need for more money to grow, and they might struggle to keep up with new innovations. They also depend on third parties for crucial services like construction and logistics, which adds another layer of risk. And importantly, their Class A ordinary shares now trade on the OTC Pink Limited marketplace, which can mean less liquidity, making it harder to sell shares, and potentially more price swings. The company is betting big on its unique technology to turn palm kernel shells into graphite and graphene. They've got patents to prove their process is one of a kind for mass production using biomass. This is a key differentiator, as they claim their product can be higher quality and significantly cheaper than competitors. They even have a supply agreement worth $30 million annually with Toyota, a big name in the automotive sector, for their carbon-neutral mobility products. This could be a game changer if they can deliver. Let's quickly look at who is running the show. Chris Wei is the CEO, CFO, chairman, and a director. He's got a background in corporate finance and accounting. The other directors bring expertise in areas like accounting, financial planning, and food science. The board is divided into classes, meaning not all directors are up for re election at the same time, which is a common practice to ensure stability. They've also made sure to have a majority of independent directors, which is good for corporate governance. Regarding compensation, Chris Lai, the CEO, has a base salary of about $63,000 a year, plus an allowance of around $85,000, and he'll also be issued company shares worth about $106,000. The other directors will receive a monthly fee of about $530. They also have an equity incentive plan to grant shares to employees and directors, aiming to align everyone's interests with the company's success. This is a critical note. The auditors are flagging a substantial doubt about the company's ability to continue as a going concern. This is because they lost over $16 million in the last year and have a working capital deficit of about $10 million. On top of that, their stock has been delisted from the Nasdaq Global Market and is now trading on the OTC Pink Limited. This makes it harder to get funding. They're trying to get more money from banks, other financial institutions, or through equity financing. They did manage to raise about $1.4 million in late 2024 and had some debt settlements, but it might not be enough. It is interesting to note that Graphjet Technology isn't paying income taxes in the Cayman Islands, where they're incorporated. Their US subsidiary is dormant, and in Malaysia, where their main operations are, the tax rate is 24%. However, because they're currently operating at a loss, they're not paying any income tax there either. They have significant net operating losses that can be carried forward, but they've put a full valuation allowance against these deferred tax assets because they're not sure when they'll be able to use them. This is typical for companies that are still building their business. Looking at what happened after September 2025, Graphjet Technology entered into a loan agreement for about $7 million secured by company shares. More significantly, their stock was delisted from the Nasdaq Global Market on the 13th of November 2025 and started trading on the OTC markets. They're appealing this decision, but it is a tough situation. They also increased their authorized share capital significantly, which is often a move to prepare for future fundraising or stock issuances. So, what is the verdict on Graphjet Technology? They've got a genuinely innovative idea that addresses a growing market need for sustainable critical materials. Their patented technology and focus on using waste products are strong points, and that Toyota deal, if it materializes fully, could be a massive win. However, the financial picture is concerning. The massive net losses, the shareholder deficit, and especially the auditor's going concern warning painted a stark picture of their current financial health. The delisting from Nasdaq and move to OTC Pink adds another layer of risk, potentially making it harder to raise the capital they desperately need to scale up. In my opinion, Graphjet Technology is a high-risk, high-reward play. The technology is fascinating and the market opportunity is huge, especially with the push for electric vehicles and green energy. But they are a long way from profitability and need to demonstrate they can execute their production plans and secure sustained funding without their stock price cratering or their operations grinding to a halt. It is a company with a lot of potential, but also a lot of hurdles to overcome. Keep a very close eye on their ability to secure funding and scale up production. What is your take on Graphjet Technology's chances? Are they on the path to revolutionizing materials science, or are they facing an uphill battle? Let me know your thoughts in the comments below. And if you found this deep dive valuable, please hit that like button and subscribe for more corporate breakdowns. Don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.